Hi, my name is Ronak Ailawadi, and today we'll be talking about emerging markets in the global stock market. So first, an overview. Emerging markets make up about 12% of the global equity market cap, compared to the US, which is about 65% of the global equity market cap, and other developed economies, such as European economies, that are about 25%. Overall, the market cap of emerging markets is substantial at 12.4 trillion, and we've seen a lot of money coming into emerging market ETFs this year, with over 40 billion in just the first half of the year. That's more than all of last year already. As far as advantages and considerations of these emerging markets, they offer higher growth potential. These emerging markets are economies that are up and coming. So India, for example, has been growing at almost 8% per year. China has been growing at over 5% per year. And this is much higher than developed economies such as the United States at 2%, as well as European economies, which are around 1%. Emerging markets also have more favorable demographics on average. India's median age is around 30 compared to higher in the US and other developed economies like Japan, and this will help support long-term growth in emerging markets. They also have attractive valuations with significantly lower PE ratios compared to other developed economies such as the S&P 500 in the United States. They also offer a sense of portfolio diversification as they typically don't track the US stock market, and in times of turmoil in the US economy could act as a hedge. However, there are also some things to consider, including currency risk. These currencies are less stable than the US dollar, and almost every emerging market currency has depreciated against the US dollar in recent years. There's also political risk. For example, in 2024, Korea underwent martial law for a short amount of time in December, and that led to decreased investor confidence. Third, there's governance risk, which means that there's weaker corporate governance standards compared to the regulation and corporate governance in the United States and other developed economies, leading to potential market manipulation by these economies. As far as the agenda today, we'll first talk about emerging markets from a macroeconomic perspective before moving into a company-specific perspective. Looking at the region weights for the major emerging market ETFs, we can see that Taiwan by far is the biggest component of these emerging market ETFs at 25 to 30%. South Korea is not in every emerging market ETF, but in the ones that it's in is usually the second largest component, between 20 and 25% usually. China is on average the third biggest, although in some ETFs, such as the ones that do not include South Korea, China makes up a larger share, between 20 and 30% in total. India is the fourth largest at around 12% in some, but ranging up to around 16% as well. Together, these top four countries make up about 80% of the emerging market weight, which is a significant change from years in the past. Beyond that, Brazil, South Africa, Saudi Arabia, and Mexico make up small portions of these ETFs, but still not insignificant. Looking into the countries one by one, we'll start with India, which has had the fastest GDP growth in the group of 20 at almost 8%. They're the fastest growing economy and above the United States and China, as well as many other large economies in the world. We've also seen a China plus one manufacturing shift. Companies are starting to diversify beyond China to other countries as well, including India. For example, Apple now assembles over 25% of their phones in India, which is up 53% compared to last year. For example, India-made iPhones were 44% of phones that came into the US this past year, compared to only 13% last year. India is also embracing AI. They're building $200 billion of infrastructure for AI, with major companies like Microsoft, Google, and Tata building Indian tech hubs and AI cities. They're also taking advantage of trade deals with the US in February, which cut tariffs from 50% to under 20%. India's goal as a whole by the government is to turn into a fully developed country by 2047. India also has strong domestic demand, which is a unique aspect of the country compared to other countries. Private consumption makes up almost 60% of GDP, which is far bigger than most other emerging market economies, which provides some protection against global events. However, they are only spending 0.6% of GDP on research and development. This is compared to over 3% in the US and over 2% in China. On a dollar per dollar basis, India spends 40 times as less on research and development compared to the US and over 20 times less than China. In addition, the Indian rupee, the currency, has been declining over 15% over the past 2 years. We've also seen foreign selling of Indian stocks, and the Indian stock market has been relatively flat to slightly down over the past year, although it has been up over the past 5 years. One reason for this is that Indian companies were trading at extremely high valuations and high PE ratios. However, now they're trading at more modest ratios, which could make the investments more attractive. In addition, India imports almost all of its oil, and with the conflict in the Middle East, has had increased oil prices and increased inflation that has been higher than expected. Finally, the economy is expected to grow slightly lower at about 6.3% this year. However, that is still substantial growth. In terms of China, China has seen 5% GDP growth in 2025, and it has been constant at about 5% for the past couple of years. Notably, the currency is one of the strongest in the emerging markets, and that is something that is able to protect investors. Exports also have decreased to the US, but overall, China was able to rebalance its exports, and exports actually grew almost 20% year over year. Furthermore, China presents a unique opportunity in that Chinese equities trade at an especially large PE discount, and this could be a potential opportunity for investment. China also is embracing AI with over 70% of global electric car production. They also have a lot of AI investment over the past couple of years, especially in the tech industry. There are also some concerns with retail sales growth. For example, retail sales growth has had its lowest year in over 10 years and a large slowdown from the 2010s. They also have low consumption compared to other countries, with private consumption only being 40% of China's GDP, compared to 60% in the US. Retail sales growth has also been small, at less than 1% compared to over 10% in the 2010s. China also suffers from lower consumption relative to other economies, at around 40% of GDP compared to around 60% in the US. Furthermore, the property sector makes up about a third of GDP and has been down for the past couple of years. 70% of household assets are in property, so this is something to monitor over the next couple of years. Now looking at the primary drivers of these emerging market ETFs, making up almost 50% of them, we have Taiwan and South Korea. First, with Taiwan, GDP growth is the strongest out of any emerging market at almost 9%. This is the fastest growth in Taiwan in over 15 years, and faster than India, which is growing very fast, as well as China. Taiwan is also growing in the first half of this year at over 14%. So this growth is accelerating, although the growth is expected to slow slightly throughout the rest of the year. Among the contributors to this growth is Taiwan Semiconductor Manufacturing Company, which alone contributes almost 10% of Taiwan's entire GDP. We'll talk about this company in a little bit. The AI boom as a whole is carrying the economy. Electronic components are 80% of total exports, and exports are up 36% this year. Overall, Taiwan is a very tech-based economy. Furthermore, a US-Taiwan trade deal cut tariffs, which benefited both countries, and Taiwan also committed to building investment in the United States. For example, Taiwan Semiconductor is building a mega factory in Arizona. If we look at South Korea, their GDP growth has been much slower at 1%. Semiconductors, however, are the biggest contributor to this economy. They're 40% of exports, and they've set 13 monthly export records in a row. Samsung profits are also up 800% this year, and the Korean stock market is up significantly. However, a reason for this lower growth may be the martial law that South Korea had at the end of 2024, which impacted the GDP in 2025. In 2026, South Korea's growth is expected to recover back up to 2.6%. South Korea is also investing over $500 billion in AI chips. They want to become the AI leader of the world. And Samsung and SK Hynix, two mega cap companies, are leading this charge, especially with their high bandwidth memory chips. And these are the chips that go into AI processors and AI data centers. However, something to watch in South Korea outside of this is that exports outside of the semiconductor industry only grew 1.1%. So South Korea's growth is largely dependent on the semiconductor industry. Looking into South America and South Africa, we can start with Brazil, whose GDP has grown 2.3% in 2025. In 2024, Brazil's GDP growth was over 3%, and then this past year it slowed down to that 2.3% figure. This coming year, it's supposed to be less than 2.3%, at around 1.9%. Interest rates are also very high, at around 14%, which are near record highs, so it's hard to stimulate investment and consumption. Brazil does benefit from the increased oil prices, however, and they are a primary exporter of natural resources. They are the world's number 2 iron ore exporter, and they also are the world's largest coffee and soybean exporter. So these raw materials are key to Brazil's economy. Also key to Brazil's economy is China, which buys 30% of Brazil's exports, and commodities are 90% of those. So China's economy does have a big impact on Brazil as well. The currency is also down 50% over the past decade, but it is currently stable. So overall, Brazil is a bit of a mixed bag. In terms of the rest of Latin America, Mexico has had very slow GDP growth recently. It's the lowest in over 5 years, and domestic consumption has been at record lows for 19 months in a row. 80% of Mexican exports go to the US, and exports are about 40% of Mexico's economy. So that means exports to the US from Mexico make up over 30% of GDP. This is a significant number and something to monitor with US and Mexico trade deals. In terms of Chile and Peru, both of them are benefiting from increased demand for copper and natural resources from the AI boom. And finally, Colombia has a struggling economy, especially because their past administration shifted away from the historical reliance on fossil fuels. However, their newly elected president is expected to shift back towards fossil fuels, which could provide some growth in the economy. South Africa is a bit of a mixed picture as well. GDP has only grown 1.1%. However, that is very fast compared to previous years in South Africa, and it's at record highs. However, this is much slower than the rest of the emerging market economies. And South Africa is definitely an economy that is more reliant on natural resources like Brazil. They produce lots of platinum and gold and iron, and they have benefited from higher prices with gold in recent years. South Africa has also been investing in renewable energy to back up their power grid. Before, their power grid provided 40% less power than the amount needed to keep the country running. As a result, South Africa needed to cut off the power grid for hours at a time, which affected businesses in the country. However, due to their recent investments, they've stopped that practice of cutting off the power, called load shedding, and this is expected to stimulate business growth in the future. While South Africa is also attracting less investment compared to places like Asia, South Africa does have less investment than Asia in terms of AI. They are the AI hub of Africa. AI data centers in the country are expected to grow over 40% every single year for the next 6 years. However, at the same time, there's important things to monitor with the economy, including the extremely high unemployment rate at over 30% and potential conflict. Currently in South Africa, the locals are blaming the immigrants for this high unemployment rate, which is causing some conflict. South Africa also has extremely high debt, which is impacting their fiscal credibility. Now we'll move into the company-specific perspective. First, we'll look at the semiconductor and AI chip producers in the world. And Taiwan Semiconductor, Samsung Electronics, and SK Hynix are the 3 biggest producers of this in the world. First, Taiwan Semiconductor is the largest pure-play semiconductor manufacturer in the world. They are only a manufacturer, which is different than some other companies in the industry. They manufacture for most of the tech industry, especially for chips that are for iPhones as well as AI chips. Their revenue this past year was over $100 billion, and most importantly, increased over 35% compared to last year. 61% of the revenue that they make is coming from AI chips, and they're shifting more towards that as we speak. In addition, their revenue this past quarter was a further increase at over $40 billion, which is also another 35% increase compared to last year's already elevated highs. In terms of Samsung, Samsung is a conglomerate, so they do multiple things. They create memory chips, but they also create phones, TVs, and appliances and other everyday things. That's why their profit margin is a bit lower than Taiwan Semiconductor and SK Hynix, but they also are still making record profit. Compared to Taiwan Semiconductor, their revenue from semiconductors and chips is a little bit lower at 39%, but still a significant amount. Notably, they focus on AI memory chips, which are the big profit makers in the industry, and it's why their profit this past quarter was up over 18 times compared to last year. In addition, the money they've made just this past year is more than all of their profits in the last 40 years combined. SK Hynix is another Korean chip company and is a pure play memory chip maker. So what that means is they focus specifically on the AI memory chips and make even more of it than Samsung. So Samsung and SK Hynix are the two contributors to the high bandwidth memory AI chips. As a result, SK Hynix has an incredibly high net profit margin compared to these other two countries. And although they missed their earnings that were projected by the street in this past quarter, they still showed over 500% increase in profit. You'll notice here that the market caps of these three companies is extremely large. A common misconception of emerging markets is that it's mostly smaller companies. But as you can see here, these are three of some of the biggest companies in the world. Next, we'll look at some of the Chinese holdings in the ETFs, including Tencent and Alibaba. Tencent is a large internet company. They run the commonly known WeChat, which is a messaging and payments app. It's used by almost everyone in China, but they also operate a large video game business. They own the company that runs the popular game Clash of Clans, as well as they own Epic Games as well. They also have 25% of the business invested in other companies, which is a unique aspect of Tencent. These companies include Snap, Reddit, and Spotify. The shares are relatively flat over the past 5 years compared to the semiconductor stocks, which have shot up in recent years, but still present an interesting opportunity. They're investing significantly in AI data centers in recent years and building their own version of ChatGPT. So although their earnings and profit have been lower in recent years, this is seen as more of a long-term bet on their AI. Alibaba has similarly been investing in the cloud and AI compared to what they've done prior, which is run a business similar to Amazon and eBay for Chinese shoppers in the e-commerce industry. About 900 million people shop on the platforms every year, and this is expected to expand in coming years, especially as companies internationally begin to use their cloud. Alibaba shares have been down over the past 5 years. However, with the increased investment in the cloud, there could be some future profits, so this is something to monitor. We'll also look at some Indian companies here. This include HDFC Bank and Reliance Industries. Now, compared to other countries, India does have a little bit more corruption, which is something to monitor. HDFC Bank is a typical bank and India's largest private bank with almost 100 million customers, but recently their CEO did have to step down due to allegations of corruption and a potential scandal. They're currently being investigated. Reliance, on the other hand, is India's biggest company and does essentially everything from energy to retail to telecom. They also own Jio, which is India's largest wireless carrier, and it serves more than 500 million subscribers and is expected to have its own IPO. Furthermore, Reliance is investing heavily in AI. They're building data centers alongside Meta in India, and they're also developing solar energy and batteries as new product lines in their business. Again, this is India's biggest company. Our last company that we'll be analyzing is Vale, which is a Brazilian company and the world's largest iron ore producer. Despite being in Brazil, the primary source of Vale's revenue is from China. This is because China uses an immense amount of natural resources, and Brazil exports these natural resources to China. However, their net income and profit has been falling lately, especially due to the increased supply of nickel worldwide, especially in Indonesia, which has decreased prices and their profit margins. They're also diversifying away from iron ore as a response to this, and copper is now the fastest growing part of the business, It has grown 25% in the past year. In addition, there's a new deposit in Guinea called the Simandou mining project, and it's bringing lots of new iron ore deposits, and China is getting a large supply of these iron ore deposits. Valley expects China to need less of their iron ore because of these other sources and is as a result shifting to India instead. However, this is a work in progress. Valley does have a high dividend, however, at 6%. And despite the decrease in profit, they have seen an increase in revenue this past year. Now we'll look at some of the changes of emerging markets in the past 10 years. We can see that the concentration in China has decreased, while it's increased significantly in Korea and Taiwan, mainly due to the AI industry. It's also increased slightly in India, while decreasing slightly in Brazil. Notably, the top 10 company holdings make up much more weight now compared to 10 years ago, showing that there's more concentration in the industry. In addition, the top holdings 10 years ago were only about 4%, with Samsung, Tencent, and Taiwan Semiconductor all being around that range. However, now Taiwan Semiconductor makes up over 15%, Samsung and SK Hynix both make up just under 10%. So it's a lot more concentrated in these top couple companies. So just to summarize everything we've talked about so far, there are two things that are important to look at: the macroeconomics, which is the state of these economies, including India and Taiwan growing much faster than developed markets. Overall, emerging market economies tend to grow much faster compared to developed economies, and there's lots of investment coming into these countries. However, it is still important to monitor the growth in future years. And second, company fundamentals. Company fundamentals have been strong recently through AI and memory chip demand being at all-time highs. However, it's important to monitor this for the future. And finally, the investment philosophy is to stay diversified and stay long-term. These offer a hedge against other markets and could present a unique opportunity of diversification. Thank you for watching.